Disclaimer.
What if I told you that right now, at this exact moment, there are two completely different prices for the same metal? Not a few dollars apart. We're talking about a 50% difference that is tearing apart one of the oldest financial markets in the world. Picture this scenario. You open your trading app Tuesday morning, and silver shows $89 an ounce on the COMEX exchange in New York. That's the official American price, the number our financial system recognizes as reality. But in Dubai's legendary gold souk, where dealers have moved precious metals for generations, buyers are literally screaming offers at $135 for the exact same metal. In Shanghai, the premium has pushed even higher as industrial buyers fight over whatever physical inventory remains available. This isn't a glitch in the matrix. This is what happens when someone flips a kill switch on our entire financial system while we were taking a 3-day weekend. Here's what our government and Wall Street didn't tell you about that quiet Friday before Martin Luther King Jr. Day. While American markets prepared to close for the long weekend, China made a move that most analysts are only now beginning to understand. They didn't announce it with press conferences or dramatic statements. They simply updated an administrative policy that went into effect January 1st. And the implications are about to reshape everything we thought we knew about commodity markets. China moved silver from a standard quota system to what they are calling strategic state trading status. You might think that sounds like bureaucratic shuffling, but let me translate what that actually means for our markets and your investments. As of the first day of this year, only 44 companies in the entire world are now authorized to export Chinese silver. Think about that number for a moment. 44 companies control access to roughly 70% of the world's refined silver supply. And if your name isn't on that very short list, you're effectively locked out of the primary source that's kept Western markets functioning for decades. This is what I call the dual license trap, and it's already choking the supply chain that feeds everything from our solar panels to the chips in our smartphones. According to data from Chinese customs authorities, the average wait time for export permits has stretched beyond 45 days, and that's assuming you're one of the 44 chosen companies. For everyone else, Chinese silver might as well be on Mars. But here's where the story gets really interesting for us as Americans. The COMEX exchange in New York, the place where silver prices are supposedly discovered and set for the entire Western world, was completely dark for 72 hours over that long weekend. Our markets were closed, our traders were off, and the algorithms that usually keep prices in line across global markets were effectively asleep. During those 3 days, something remarkable happened in the physical silver markets of the East. The premium for actual metal, real bars you can hold in your hand, decoupled from paper prices by more than 50%. Dealers in Dubai and Shanghai watched as desperate industrial buyers bid up physical silver while the COMEX sat frozen at its Friday closing price. It was like watching two parallel universes drift apart in real time. And when our markets wake up Tuesday morning, the traders holding short positions are going to discover they've been caught in a trap that was set while they were enjoying their Monday off. Now, you might be thinking this is just temporary market volatility, the kind of thing that smooths itself out within a few trading sessions. That's what conventional wisdom would suggest, and that's exactly what makes this situation so dangerous for anyone who hasn't prepared. China didn't just restrict exports randomly. They tied their new policy to an 80-ton production threshold that has effectively decapitated the global supply chain. Here's what that means in practical terms. For decades, hundreds of small-scale refiners across China provided what market analysts call slack in the system. These smaller operations could ramp up production when prices spiked, or shift supply between domestic and export markets to smooth out temporary disruptions. They were the buffer that kept our Western market stable even when demand surged. China's new 80-ton minimum has wiped out nearly all of these smaller players overnight, removing them from the export market entirely. According to the China Non-Ferrous Metals Industry Association, more than 300 refiners who collectively produced roughly 12,000 tons of silver annually are now prohibited from exporting under the new rules. That's not a footnote in some trade journal. That's the equivalent of removing 15% of global refined supply from the market that serves our industrial base. The slack is gone, and what we're left with is a rigid, controlled pipeline that runs through exactly 44 gatekeepers who answer to Beijing. You know what should really grab our attention? The COMEX registered category of silver, the metal that's actually available for delivery to settle futures contracts, has dropped to just 35 million ounces. To put that number in perspective, the global solar industry alone consumes roughly 140 million ounces of silver per year. And that's before we account for the explosion in artificial intelligence infrastructure that requires silver-based components. The Bank of America recently estimated that AI data centers will consume an additional 50 million ounces annually by the end of this year. Do the math with me for a second. 35 million ounces in the COMEX registered category, divided by the combined annual demand from just solar and AI sectors. That's less than 3 days of industrial consumption sitting in the vaults that are supposed to back our entire paper silver market. 3 days? We have strategic petroleum reserves measured in months, grain reserves measured in weeks. But the commodity that powers our green energy transition and technological infrastructure has less than a long weekend's worth of supply backing the contracts that thousands of investors and institutions believe represent real metal. Have you noticed something strange about the narrative we keep hearing from mainstream financial media? They keep calling this a Reddit squeeze, or retail investor speculation, as if a bunch of amateur traders on the internet somehow convinced China to restructure their entire export system, and convinced industrial giants to bypass traditional markets. That story doesn't add up, and it's not what's actually happening on the ground where real business gets done. The 72-hour blind spot created by our holiday weekend wasn't just an inconvenience for day traders. It was a window where the physical reality of metal markets divorced itself from the paper fantasy that our financial system has been selling. While our exchanges were dark, the people who actually need silver to manufacture products were making desperate calls to secure supply, and they weren't calling futures brokers. They were calling mine operators directly. This brings us to Tuesday morning, and what you need to understand about how fast a market can shift when the underlying reality no longer matches the official story. When the opening bell rings and our algorithms wake up, they're going to see that $50 premium gap between physical and paper markets. They're going to calculate the arbitrage opportunity, buy on the COMEX, ship to Dubai, collect the difference. It's the kind of simple, profitable trade that computers execute thousands of times per day across every commodity market. Except this time, there's no metal to ship. The Chinese supply is locked behind a licensing system that takes months to navigate. The COMEX registered inventory is already spoken for by existing contracts and industrial buyers who placed orders weeks ago, and the mining companies that might increase production to meet demand. According to the Silver Institute, global mine production peaked back in 2016 and has been in decline ever since, as ore grades collapse in major producing regions like Mexico and Peru. So what happens when the algorithms try to execute that arbitrage trade and discover there's no physical metal available to complete it? What happens when the mathematical models that assume infinite liquidity run headfirst into a finite physical resource that's already been claimed by manufacturers who need it to keep their factories running? That's what Tuesday morning is really about. It's not just another volatile trading day where silver moves up or down a few percentage points. It's the moment when our paper market discovers it has been writing checks that the physical market can no longer cash, and the people holding those paper promises are about to learn a very expensive lesson about the difference between owning an asset and owning a claim on an asset that may no longer exist. The kill switch was flipped while we were sleeping. The question now is whether our markets can wake up fast enough to understand what just happened, or whether Tuesday opens with the kind of gap that makes circuit breakers start tripping before most Americans have finished their morning coffee. Let me show you something that should fundamentally change how you think about what's happening in silver markets right now. This is not a story about amateur investors on Reddit forums squeezing hedge funds or day traders getting lucky on a momentum play. What we're witnessing is something far more serious, and it involves the companies that build the technology you're probably using to watch this right now. Tesla needs silver for the electrical contacts in every vehicle they manufacture. Taiwan Semiconductor Manufacturing Company, TSMC, requires silver for the conductive pathways in the chips that power everything from your iPhone to military systems. These aren't retail investors speculating on price movements. These are industrial giants who've suddenly realized that the normal channels they have relied on for decades are no longer reliable, and they're making moves that Wall Street analysts are only beginning to understand. Here's where the story gets really interesting for anyone who thinks they own silver through traditional investment vehicles. According to multiple reports from supply chain consultants working with major tech manufacturers, these companies have started bypassing the paper markets entirely. They're not calling brokers at the COMEX to buy futures contracts. They're sending procurement teams directly to mining operations in Mexico, Peru, and Australia to lock in supply agreements that guarantee physical delivery months or even years in advance. Think about what that means for a moment. When the companies that actually consume millions of ounces of silver annually decide they can't trust the traditional commodity exchanges to deliver real metal when they need it, they're essentially declaring that the entire pricing mechanism we've relied on has become fiction. They're saying the paper market and the physical market are now two completely different things, and only one of them matters if you're trying to manufacture products in the real world. Pop quiz. If you own silver through an exchange-traded fund or a futures contract, do you own metal or do you own a promise? The difference between those two things is about to become very expensive for a lot of people who assumed they were the same. Let's talk about JPMorgan for a minute, because what they've been doing this month tells you everything you need to know about which direction the smart money is really moving. In January alone, JPMorgan has delivered 8.1 million ounces out of the COMEX system. Now, mainstream financial media reported this as JPMorgan selling silver, as if they were taking profits and exiting their position. But that's not what the delivery data actually shows when you dig into the warehouse receipts and understand how this system really works. Those 8 million ounces weren't sold to close out a position. They were drained from the publicly available supply to satisfy obligations, while JPMorgan simultaneously built up massive long positions in the derivatives market. According to the latest Commitment of Traders report from the CFTC, JPMorgan's positioning suggests they're betting heavily on significantly higher prices in the coming months. They're not selling silver, they're consolidating control over physical inventory, while retail shorts and institutional investors who thought they were playing it safe are about to discover they're holding the wrong side of a trade that's about to move violently against them. You want to know what really confirms this isn't just market speculation? On January 15th, our own government made it official. The Department of Energy and the Department of Defense jointly issued a national security memorandum that officially classified silver as a critical mineral, with what they termed high vulnerability to foreign disruption. Let me translate what that bureaucratic language actually means for anyone who thinks their silver investments are safe in a vault somewhere with their name on it. That designation gives the United States government the legal authority to redirect, confiscate, or commandeer silver supplies for national security purposes, military applications, or critical infrastructure projects. Your allocated silver, the metal you think is sitting in a vault with a specific serial number attached to your account, might already be earmarked for a Patriot missile system or a solar farm that is part of the National Grid Modernization Program. The government just gave itself the right to tap you on the shoulder and say, "We need that metal more than you do." Well, when there's not much you can do about it except accept whatever compensation they determine is fair market value. Have you noticed how the narrative around silver has shifted in just the past few months? A year ago, financial advisors called it a pet rock, an outdated commodity that had been replaced by better technologies. Now suddenly, it's a critical national security asset that requires government oversight and protection. What changed? The metal didn't change, and the supply situation did, and the people who make decisions about our economy finally woke up to the fact that we've created massive dependencies on a material we do not control and can't easily replace. Let's talk about the supply deficit that nobody wants to acknowledge publicly, but everyone in the industry knows is real. For 6 consecutive years, the world has consumed more silver than it has produced from mining operations. That's not a controversial statement. The Silver Institute publishes this data annually, and every major mining company confirms it in their earnings reports. But here's what makes this year different from the gradual deficits we saw building up over the previous half-decade. We've hit what supply chain analysts call the hard floor. Silver mine production peaked globally in 2016 at roughly 880 million ounces annually, and it's been declining ever since as ore grades collapse in the major producing regions. Mexico and Peru, which together account for nearly 40% of global mine supply, are reporting ore grades that have fallen by 30 to 40% over the past decade. That means miners are processing vastly more rock to extract the same amount of silver, and at a certain point, the economics simply don't work anymore. According to S&P Global Market Intelligence, bringing a new silver mine from discovery to production takes an average of 12 to 15 years and requires hundreds of millions of dollars in capital investment. There's no quick fix coming from new supply. The mines that will serve the market in 2030 should already be under construction right now, and they're not. The exploration budgets that would need to be deployed today to find tomorrow's supply have been cut repeatedly over the past decade, as miners focused on higher margin commodities like copper and gold. So what happens when industrial demand keeps climbing while mine supply keeps falling, and the geopolitical tensions we're watching make it harder to move metal across borders? You get a market that looks stable on the surface because paper prices haven't exploded yet, while underneath, the physical fundamentals are screaming that something has to give. Here's a number that should genuinely concern anyone who thinks the COMEX can continue functioning as a physical delivery market. The paper-to-physical ratio, the number of ounces that trade as contracts compared to the actual metal available for delivery, has reached 400 to 1. For every single bar of real silver sitting in a COMEX warehouse, there are 400 people who own contracts that say they have a claim on metal. Think about that scenario playing out in any other part of your life. Imagine if your bank told you they had $1 in the vault for every $400 shown in customer accounts. But don't worry, because surely not everyone will want their money at the same time. Or imagine if airlines sold 400 tickets for every seat on the plane, betting that most people won't actually show up. When does that work? And when does it end in disaster? The COMEX system has functioned for decades based on the assumption that most contract holders will roll their positions forward or settle in cash rather than demanding physical delivery. That assumption worked beautifully when silver was primarily an investment vehicle, and speculators outnumbered industrial users in the futures market. But something fundamental has shifted in the past 18 months that's breaking that model. Industrial users, the manufacturers who actually need physical silver to operate their businesses, have started taking delivery in unprecedented numbers because they can't rely on being able to source metal on the spot market when they need it. Solar panel manufacturers, electronics companies, and automotive suppliers have all reported similar experiences. They place orders for physical silver, and they're told deliveries will be delayed by weeks or months, or they're quoted premiums that make no sense compared to the official exchange prices. So these industrial buyers have started doing what any rational business would do when their supply chain becomes unreliable. They're going directly to the source, bypassing the exchanges entirely, and locking in supply agreements that guarantee physical delivery. That's not speculation. That's survival for companies that have multi-billion-dollar production schedules depending on reliable access to raw materials. According to a recent survey by Metals Focus, a London-based research consultancy, more than 60% of industrial silver consumers have increased their inventory targets for this year compared to 2024. They're not building inventory because they think prices will go up. They're building inventory because they're genuinely worried about their ability to source material at any price if the current supply disruptions continue or worsen. You know what's almost funny about the official narrative we keep hearing? Mainstream analysts keep saying that silver prices are being driven by investment demand, as if this is all just financial speculation disconnected from physical reality. But when you actually look at the data from manufacturing sectors, you see something completely different. The Photovoltaic Industry Association reports that solar installations in China alone will consume approximately 160 million ounces of silver this year, up from 130 million last year. The electric vehicle sector's silver consumption is projected to grow by 40% as production scales up across North America, Europe, and Asia. This isn't money flowing into silver because investors think it's a good trade. This is actual physical metal being consumed in manufacturing processes, turned into products, and effectively removed from above-ground supply forever. Unlike gold, which mostly sits in vaults and moves from one owner to another, roughly half of all silver mined each year gets consumed in industrial applications and never returns to the market. Here's what keeps me up at night when I think about where this situation is heading. The buffer that used to exist between supply disruptions and crisis has been systematically eliminated over the past several years. Companies run just-in-time inventory systems now. They don't want to tie up capital in warehouses full of raw materials. Governments sold off strategic stockpiles during the decades when silver seemed abundant, and the financial system built increasingly complex derivative structures on top of a physical foundation that was getting smaller and more fragile every year. We've basically created a supply chain that has no margin for error, and then China walked up and introduced a massive error into the system by locking down exports through their new licensing requirements. The Tuesday market open is not just going to be about price discovery, it's going to be about whether our financial markets can even function when the gap between paper claims and physical reality becomes impossible to ignore any longer. The people who make your phones and build your cars have already figured out what's happening. They've moved past the paper market and they're securing real metal directly from sources they can trust to deliver. The question you need to ask yourself is simple. Are you ahead of that curve? Or are you still holding paper promises from institutions that are about to discover they've sold the same ounce of silver to 400 different people? Let us talk about what happens Tuesday morning when the opening bell rings and reality comes crashing into our financial markets with the force of a freight train that nobody saw coming. Picture the scene at any major trading desk in New York or Chicago right now. Algorithms that have been dormant over the holiday weekend are about to wake up and scan global markets for arbitrage opportunities. Those beautiful low-risk trades where you buy something cheap in one market and instantly sell it for more in another market. It's the kind of mathematical certainty that computers execute thousands of times every day across currencies, bonds, and commodities. These algorithms are going to see that $40 gap between the official COMEX price and the physical premiums being paid in Dubai and Shanghai, and they're going to calculate a seemingly perfect trade. Buy silver contracts on the COMEX at $89, take delivery of physical metal, ship it to the Middle East or Asia, and sell it for $135 or more. That's a 50% return on a commodity trade that should take just a few weeks to execute. Here's the problem that's going to break this entire system within seconds of the market open. There's no metal to deliver. The COMEX registered inventory that is actually available to fulfill delivery requests is already spoken for by industrial buyers and existing contracts. The Chinese supply that could theoretically replenish those inventories is locked behind a licensing system that takes months to navigate, assuming you're even one of the 44 approved companies. And the mining companies that might increase production to meet this sudden demand, they're already operating at capacity, and it takes years to expand mine operations, not days. So what happens when thousands of algorithmic trading systems simultaneously try to execute the same arbitrage trade and discover there's no physical metal available to complete it? What happens when the buy orders flood into the COMEX market and there's nobody willing to sell at prices anywhere near the official closing levels from Friday? You get what traders call a gap-up opening, a situation where the opening price is dramatically higher than the previous close because there simply aren't enough sellers at lower prices to absorb the demand. But this isn't going to be a normal gap where prices jump a few percent. According to several institutional traders I've spoken with who've been modeling this scenario over the weekend, we're looking at a potential $30 gap or more within the first few minutes of trading. Think about what a $30 gap means for anyone holding short positions in silver futures. Every dollar that silver moves higher represents $50,000 in losses per standard futures contract. A $30 move means $1.5 million in losses per contract. And according to the latest CFTC data, there are approximately 460 million ounces worth of short positions currently open in the silver futures market. Do the math with me. 460 million ounces times a $30 price move equals $13.8 billion in losses that would need to be covered instantly. But here's where the nightmare scenario really kicks in for the institutions caught on the wrong side of this trade. To cover a short position, you have to buy. And when everyone with a short position tries to buy at the same time in a market that has no available supply, prices don't just rise, they explode vertically as each successive buy order has to bid higher and higher to find anyone willing to sell. That's what I call the arbitrage vacuum. The moment when the mathematical models that assume infinite liquidity and smooth price curves run headfirst into a market that has neither. The algorithms will try to execute their arbitrage trades, they'll fail to secure physical metal, and the resulting cascade of forced buying will trigger circuit breakers and trading halts before most Americans have even checked their phones Tuesday morning. Now, you might be thinking that surely the exchanges have safeguards in place to prevent this kind of chaotic scenario. And you'd be absolutely right, they do have safeguards. The question is whether those safeguards protect you or whether they protect the institutions that run the exchanges. Let me tell you about something called Rule 589 in the CME rulebook. This is the emergency provision that allows the exchange to declare a force majeure event and switch from physical delivery to cash settlement when extraordinary circumstances make it impossible to deliver the underlying commodity. In plain English, that means if the COMEX can't actually deliver the metal that contracts call for, they can simply pay you cash instead based on whatever price they determine is appropriate. Think about what that means if you bought silver futures thinking you were securing the right to take delivery of physical metal at a set price. Under Rule 589, the exchange can turn around and say, sorry, we can't deliver the metal, but here's some cash instead. And the price they use for that cash settlement? It's not necessarily the market price. It's whatever the Exchange Rules Committee decides is fair under the circumstances. This is why I keep saying that paper silver and physical silver have become two completely different assets. Paper silver is a claim on metal that may or may not exist and may or may not be deliverable even if it does exist. Physical silver is the actual metal in your hand that nobody can take from you, settle in cash, or suspend delivery on because of extraordinary circumstances. Citibank made headlines a few weeks ago with their bold prediction that silver would hit $100 per ounce by March. That target got a lot of attention from investors who saw it as validation that precious metals were entering a new bull market. Let me tell you why that $100 target is already dead on arrival, and why the math of what is actually happening in physical markets makes it look almost conservative. The replacement cost for silver, the actual price you have to pay right now to secure physical metal with guaranteed delivery, is already approaching $120 per ounce for large industrial buyers willing to pay premiums to lock in supply. According to conversations with procurement managers at major manufacturing companies, they're looking at delivery delays that stretch well into the second quarter of this year. And they're being quoted prices that would have seemed insane just 6 months ago. Here's what that tells us about where official exchange prices need to go just to reflect the current physical reality. The 45-day export delays from China that we're seeing right now aren't temporary glitches. They're the new normal under the strategic state trading system that China implemented in January. That means Western buyers, who used to receive Chinese silver within 2 weeks of placing an order, now face a 2-month waiting period, assuming they can secure export licenses at all. When you factor in the cost of that delay for industrial users who need silver to maintain production schedules, the carrying costs, the risk premiums, and the reality that supply might not materialize even after waiting 2 months. The true market clearing price for physical silver is dramatically higher than what the paper markets are currently showing. Let me walk you through the binary outcomes we're facing Tuesday morning, because understanding these scenarios is critical for anyone who has exposure to silver markets, either through investments or through companies that depend on silver for manufacturing. Scenario 1. The COMEX opens Tuesday morning. And within seconds of the opening bell, silver prices gap up $30 or more as algorithms and traders discover the supply shortage and rush to cover short positions or secure physical delivery. The CME triggers limit-up trading halts repeatedly throughout the session as prices surge past predetermined circuit breaker levels. By the end of the day, $6.8 billion in short positions have been liquidated, and the COMEX silver market has effectively repriced itself to reflect physical reality rather than paper fantasy. Scenario 2. The COMEX realizes before the opening bell that allowing normal trading would create a catastrophic cascade of margin calls and forced liquidations that could destabilize broader financial markets. They invoke Rule 589, declare extraordinary circumstances, and either suspend trading in silver futures entirely or force cash settlement of existing contracts at prices that protect institutional short sellers at the expense of investors who thought they were buying claims on physical metal. Both scenarios end the same way for anyone paying attention to what this really means. The COMEX, as a physical silver exchange, is finished. Even if trading continues, nobody with actual need for physical metal will trust the exchange to deliver again. Industrial users will continue bypassing the paper markets entirely, and investors who want genuine exposure to silver will have to hold actual metal rather than contracts that promise delivery from a system that just proved it can't deliver. There's another number we need to talk about because it represents what I believe will be the next major psychological barrier once the current situation resolves itself. The tariff floor of $112.42 per ounce represents the price level where imported silver becomes economically equivalent to domestic production after factoring in the new trade policies being discussed in Washington. If physical markets establish $112 as the new baseline and that price holds for any significant period, you're going to see something unprecedented in modern commodity markets. Industrial users who have been assuming silver would remain affordable and abundant are suddenly going to shift from normal procurement practices to panic hoarding. They're going to try to secure 6 months or even a year's worth of supply all at once because they can't risk production stoppages that would cost them far more than the premium they paid for the metal. According to supply chain economists who study hoarding behavior during shortages, when industrial users start panic buying, prices typically overshoot fundamental value by 50 to 100% before stabilizing. That math takes us to the $150 psychological barrier, a price level that would have seemed like science fiction a year ago, but now looks increasingly like the inevitable destination for a market where supply and demand have become fundamentally mismatched. Let me be very clear about something, because I don't want this message to sound like fear-mongering or panic. What's happening in silver markets right now isn't the end of the world or even the end of the financial system. Markets adapt, prices adjust, and life goes on. But what is ending is the comfortable assumption that paper claims on commodities are interchangeable with physical possession of those commodities. Silver has transformed from a precious metal that investors buy and sell based on macroeconomic trends into something far more significant. It's become a strategic weapon in the broader competition between economic systems and geopolitical powers. China's export restrictions aren't random trade policy. They're a calculated move in a larger game about which nations control the resources necessary for the energy transition and technological advancement that will define the next several decades. The East has essentially pointed this strategic weapon directly at the heart of Western financial markets and industrial supply chains, and they pulled the trigger while our markets were closed for a holiday weekend. That's not conspiracy theory. That's just basic game theory playing out in real time between nations competing for advantage in the global economy. So here's what you need to understand as we head into Tuesday morning. This isn't about whether silver goes up or down a few dollars. This isn't about making a quick trade or timing a market swing. And what we're watching is the moment when a major commodity market discovers that the paper market and the physical market have divorced each other. And only one of them represents real wealth that you can hold in your hand and use to manufacture products or protect your purchasing power. Tuesday morning changes everything for anyone who thought they understood how commodity markets work. The question you need to answer for yourself is brutally simple. Are you holding a bar of metal that exists in physical reality? Or are you holding a PDF file from a financial institution that is currently discovering they promised the same ounce of silver to 400 different people? The kill switch was flipped. The arbitrage vacuum is about to activate. And when the markets open Tuesday morning, we're all going to discover together whether our financial system can handle the collision between paper promises and physical reality, or whether this is the moment when one of the oldest commodity markets in the world breaks under the weight of its own fictions. The choice of what you do with that information is yours. Just make sure you understand the difference between owning an asset and owning a claim on an asset that may already be allocated to someone else, his missile system or solar farm. Because Tuesday morning, that difference is going to matter more than it ever has before.